Hi guys, welcome again to three statements model. Today I'm gonna take you through another way of handling three financial statements, that is income statement, balance sheet and cash flow statement. And I'm going to use the information which has been provided by the auditor's report. And from here you can see I have a model which has the assumptions and drives, income statements, balance sheet and cash flow statement. And apart from the three above, we also have supporting schedules. But the main three financial statements we are going to talk about are cash flow statement, balance sheet and income statement. We are going to be able to fill this together, and after that we are going to do a forecast. Assuming that we are in the year 2012, we are going to forecast the year 2013, 2014 and 2015. This means that the business was able to give us the information for the last 2 years and the current year, and the business, from the assumptions and all the information provided, we are going to be able to forecast how these three financial statements are going to look in the next 3 years. So as you can see, assumptions and drive for the current and the last 2 years has not been given, but the information provided by the business is giving us that there are some of the assumptions and drive in the next 3 years. For example, here sales year on year for the next 3 years, they are assuming that sales growth is going to increase by 6.9 every year. Gross margin is going to be 55.7 across the next 3 years. As you can see, all of them here. And we also have revenues. We have the income statement, we have balance sheet, we have cash flow statement and supporting schedules. So I want us to fill this together, and I welcome you. So the first thing we are going to do is we are going to complete our income statement. There we are just going to get the difference between revenue and cost of goods sold to get the gross profit, and that one is alt equal and fill right, shift R, then control R, and that is our gross profit. Then we have the operating expenses. Told you the other time that these are expenses which are not directly linked to the cost of goods sold. They are indirectly linked, so we are going to get these other operating expenses. We're going to do the same, alt equal. So from there we just fill right, then we'll be able to get the EBIT, the operating profit. EBIT is the earning before interest and taxes. So it means that to get that, we are going to get the difference between gross profit and total operating expenses. It has populated itself there. So we also have the interest. Remember, all these blue informations are information which were provided by the business. So just going to help them to complete these three financial statements, then we'll be able to do the forecasting. So interest The business will be paying has been paying interest of 831 every year. So to get income before taxes, we are just going to equal that. Then we fill right. So from there, we are able to get the net income. Net income is going to be income before taxes minus taxes. So remember, my format is that the negative values are put in bracket. So if I simply do this normal additions, I'll be getting the correct value. So these are common dividends. These are the amount of money from the net income which were given as common dividend to shareholders. So after completing the income statement, we will be going to balance sheet, and the information which has been provided here, as you can see, we have cash, we have account receivable, and we have inventories. So to get the total current assets, we're just going to do that. Then we fill right. We are going to be able to get the current assets. Then non-current assets, we have the property, plants, and equipment. And now the total assets is going to be the sum of total current assets plus plant, property, and equipment. So that is going to give us the total assets of that particular company. Then the liability, we have the accounts payable. That information has been given. Then other current liabilities. So to get the total current liabilities, we are just going to do the sum. We fill right. Then we get the total current liabilities. Then we have the long-term debt, which has been the information given here, the past 2 years and the current year. The long-term debt is only 13,400. They have not been paying this money back, so it has not been reducing. I think they have only been paying the interest. So now to get the total shareholders equity is equal to common stock and additional paid in capital plus retained earnings. So that one you are going to do the alt equal, then just right, then you get the total shareholders equity. Then now to get the total liability and shareholders equity, what we are going to do, we are going to get these three, total current liability plus the long-term debt plus total shareholders equity, and we are able to fill that right. And as you can see, row 76 and row 63, they are equal. That means that our balance sheet balance, the total assets balance with the total liabilities and shareholders. Then from there, now we have the cash flow statement, and remember these blue values, these are values which were provided by the company. So what we're just going to do is to get the net cash. We're going to get the net cash. So the net cash from the operating activity is going to be the net. We're going to get the net income, which is from the balance sheet. As you can see here, the net income for the year 2010 was 3,474. Remember, these values are in millions. So if you come to net income, the values are the same. That means that we are doing the correct thing. So the cash flow from operating activity, we are going to take the net income, we add depreciation. As I told you, the reason why we are adding depreciation is because this is something that did not take any value, any cash from the business. So as much as we record it as an expense in income statement, but we'll have to take it back because it did not resulted to money going out of the business. So we are going to add it here. Then we have changes in net working capital. We have the account payables. It means that the account payable reduced. The inventory, this means that the inventory increased. As you can see, they are in bracket. That means this one, account receivables decreased, inventory increased, then account payable decreased. So those are the reason why you're seeing these values here. If you continue following me for more, I'll be able to show you how this one are coming about. So here we're just going to get this value. We're going to sum all of it. We get the sum there. So then we fill right. Then after filling right, this is now the net cash by the operating activity. Then from the investment activity or investing activity, we can see that this company in 2010 they bought more property, plant and equipment, which resulted in the money going out the business. So it means that cash flow from investing activity is just that. So we fill that right. It means that they did not dispose any property, they just did the buying. So that means money went out of the business. Then we also have the financing activities. Then we have the issuance of common stock. In the year 2010, 2011, 2012, this company did not issue any common stock, so it means that they did not get any money through the selling of stocks, but paying of dividends, as I showed you here somewhere up here. As you can see, they give common shareholders their dividends in terms of the value shown here. So it means they pay the dividends, and their net addition to long-term debt, as I told you earlier, this company the last 2 years and the current year, they are not planning of taking any other debt, so they did not add any debt for these years. So it means that the cash flow from financing activity is just going to be the sum of these three. So just going to get that. We fill that right, which is already there. Then we also have increase, decrease in cash equivalent. So what we are going to do is we are going to see if there was a decrease in the cash flow from operating activity, investing activity and financing activity. So whatever we are going to do, we are going to sum this plus this plus this one here, and we are able to see that there was a decrease in cash equivalents. So we fill that right, and we are going to be able to do that. So cash and cash equivalent at the end of the year is going to be, you add that and you fill that right. Yes. So at the end of each year, this one was the net cash flow. It means that after business has done the operating activity, have invested and their financing activity, at the end of the day they remain with 3,544 million. Yeah. So we also have the supporting schedule, that this one also we need to complete it. So we can see here we have the beginning of the period. The beginning of the period, this means that these are the property, plant and equipment from the previous year, that is 2009. Then we have the capital expenditure. If that particular company spend some money in buying capital expenditures, then we also have the depreciation expense. So from here, the depreciation expenses we already have from our income statement. We're just going to use that, and we're going to make it now positive. So this is now the depreciation expenses. Then the capital expenditure. The capital expenditure, first of all, what we're going to do we have the net at the end of the period? Yes, we do. The net at the end of the period, we get that from the balance sheet, which is this one here. You feel that, right? So capital expenditure or the disposals, yes, we do have net addition to property, plant and equipment. We can see here they spend this value in 2020, 2011 and 2013. So it means that the capital expenditure is going to be, put that positive now. So we are going to just take this value here, then we get that. So we are going to fill that, right? Yes. So for us to get now the net property and equipment, property, plants and equipment at the beginning of the period, this information we were not given, but we are able to extract it from here. So what we are going to do is that to get this value, we are just going to take this, then subtract this one, then add this to get the value at the beginning of the year. So, and as we go forward, we know that the beginning of the year 2011, the net property and plant equipment will be equal to this one here. So, and the same thing goes to 2012. So we're just going to fill that, right, to get that value. So if you add this plus this and you subtract this, you're going to be able to get, because this is the plant, property and equipment at the beginning of the year, then these are the capital expenditure. That means that they spend some money buying other plant, property and equipment. Then this is now the depreciation expense, which we subtract from the total, from the property, plant, equipment, to get the net. Then we have now the retained earnings. We have the retained earnings at the end of the period. What was the retained earning? That one we get from the balance sheet. We have the retained earnings here. So we just fill that, right, to get the retained earning at the end of those periods. Then we have the dividends. The dividends we already have. The dividends, you can take this one, you can use this value, or you can use this one here. They are the same. So the best thing is to put it positive. So the dividends is going to be that. Then we have the net income. The net income we are going to obtain this one from directly from the income statement, and that's going to be that. So this means that during 2010 the net income was this, and the dividends which were paid out were these ones. So what we are going to do, we are going to get the retained earning at the beginning of the period, because the period of 2009 to 2009 we were not given. We are going to calculate this by taking this one and adding this but subtracting this one. We make the beginning of the period the subject, and we are going to be able to get that. So this one, the retained earning in the period of 2010 is going to be this, 2011 I mean. Just going to take that, and because for the one for 2012 it's just going to be the same, control right. So we get our retained earning for the period. Then we have the long-term debt. The long-term debt at the end of the period, we have that here. We take that from the balance sheet. The long-term debt, we have that. We are going to fill that right. Then addition or repayment, we understood that this particular company did not add any debt, or they did not pay any principal, so it means that that is going to be 0. You feel that, right? Then we have at the beginning of the period, because they did not add or pay the principal, the beginning of the period is just the same from the balance sheet here. So that is going to be, you feel that, right? Then we have long-term debt interest. Long-term debt interest, the interest this company was paying interest, that one you can get from the income statement. Then we have that, but now you put it to be positive to fill the reporting schedule, the supporting schedule. So this one just going to be the same as this one here. So you simply fill that right, and you now get your complete 3 financial statements.